I'm not a big fan, as I said many times, of the BIS or the central banks or the East in general, but I'm doing what the central banks do. And all of the investors at our offices are doing the same thing. We're holding in gold, or we're saving in gold, and we're spending in fiat because we see the longer term direction of gold well above 5, 6, 10,000 in the years ahead. So whether it's at 4,200, 4,100, or 3,800 right now, or the next week, or the next month, or the next hour, it doesn't phase us as gold investors, not as gold kind of traders, which we're not. We're not speculators in the space. So we've never really talked about the gold price. In fact, in the many years I've been with Egon, we never really talked about the daily price. Sometimes we won't even look at it. And that can sound very flippant. But even if you take if you take away the gold bias, the gold perspective that I certainly have and that Egon has, etc.
Matthew Piepenberg explains that he and his colleagues follow the same approach as central banks, saving in gold and spending in fiat. To him, gold represents stability in a world where currencies continue to lose purchasing power. He believes that this strategy reflects a long-term mindset focused on preserving value rather than chasing temporary profits or reacting to market noise. Gold, in his view, is a safeguard, not a speculative trade. He emphasizes that short-term price shifts, whether gold sits at $4,200, $4,100, or even $3,800, are irrelevant to true investors. Such movements, he says, only unsettle traders who lack conviction. Real wealth holders understand that gold's worth cannot be measured by daily volatility, but by its ability to endure economic storms over decades. Piepenberg predicts that gold will eventually reach $5,000, $6,000, or even $10,000 per ounce, reflecting a broader shift from fiat dependency toward tangible value. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Well, certainly it's the talk of the gold space. Of course, naturally it's going to make headlines for all kinds of good and bad reasons. Friday, gold market was down $180. The gold price closed the week, it's still $4,250. Monday was up 105, Tuesday down 260, etc. It's just these massive, gyrations in price. Relatively speaking, massive. I say that, but to me, they're very typical intraday moves in a bull market. People say that is probably just Piepenberg selling his gold book, but this is not unusual for bull markets in general. I don't look at gold as a typical asset, which we can talk about, and that's why I don't think I'm not at all worried. I was talking to Alistair McLeod and obviously Egon and Middlecoop and other interviews. It's in the same week this was going on, and none of us were even fazed by this. And again, it's because we have a stronger conviction about the secular direction of gold for all the reasons you and I have been discussing for years. But in terms of just the recent activity, the market likes to shake out nervous and levered investors. There's a lot, I'm sure, of trend followers in this gold move lately who probably had hard stop orders, with stop orders, and they got shaken out. There was also probably some profit taking in the trend camp, but the trend following camp. But again, these type of moves are not at all unusual for general bull markets. But again, gold is not a typical commodity trade. It's not a particular unique it's not a specific type of risk asset trade. It is part of the major status quo shift in the world, in the monetary setting, in the backdrop from which all these details spin. The larger question, the larger secular direction of gold is so obvious that these moves don't faze us because we hold gold for 10, 15, 20 years. Believe it or not, I'm not a big fan, as I said many times, of the BIS or the central banks or the East in general, but I'm doing what the central banks do. And all of the investors at our offices are doing the same thing. We're holding in gold, or we're saving in gold, and we're spending in fiat because we see the longer term direction of gold well above 5, 6, 10,000 in the years ahead. So whether it's at 4,200, 4,100, or 3,800 right now, or the next week, or the next month, or the next hour, it doesn't phase us as gold investors, not as gold kind of traders, which we're not. We're not speculators in the space. So we've never really talked about the gold price. In fact, in the many years I've been with Egon, we never really talked about the daily price. Sometimes we won't even look at it. And that can sound very flippant. But even if you take if you take away the gold bias, the gold perspective that I certainly have and that Egon has, etc., I think of one of my favorite investors that I allocated to, Jeremy Grantham at GMO. He's been retired now for 15 years. He was a fantastic value trader and portfolio manager out of Boston, and he had many rules of investing, but one of the things he said is that, no one likes to think ahead. Investors have a very short time horizon when they look at things, and of course the headlines are very short in the last week about the gold price, but if you step back at all the things you and I have talked about over the years, and you've talked with others, just keep it simple. Right now, entitlements in the U.S. for the past 150 years is probably the biggest Ponzi scheme in history. We have 120% debt to GDP. We have $2 trillion deficits. We're seeing breaks de-dollarization. We're seeing central banks stacking gold. We're seeing talk of a gold revaluation. We've got Judy Shelton talking about a gold U.S. Treasury. In other words, there's these massive indications of a seismic monetary shift, a geopolitical shift, and a currency shift going on in the backdrop of these intraday moves. These intraday moves are peanuts compared to the larger seismic shifts in the macro space, in the direction of the dollar, in the direction of debt, and of course the direction of precious metals. So why would you be thinking about, well, this market's topping out, I got to get out now at the top? Why would you want to sell a key asset with no counterparty risk when the entire world is riddled with signs of counterparty risk, from the U.S. Treasury and the U.S. dollar to risk assets to stable coins to AI stocks? I mean, it's fascinating to me. But again, people think that maybe this is the end of the bull run. Again, I have my bias. This is chapter 1 of a very long novel, maybe chapter 2 for the direction of gold. And it's easy to get seduced by certain headlines. I mean, even during Weimar, when you started to see wheelbarrows of money, every now and then there'd be a headline saying, the Versailles Treaty has been amended, our reparations are going to go down. And people would actually start selling gold and buying more Reichsmark. Within the next 2 or 3 weeks, the currency was getting slashed by 200-300% or doubling every 2 weeks. They thought that the problems are over. The problems that gold is an anti-fiat solution to, the problems that gold is solving or basically doing nothing but hold its value while the rest of the world devalues, those are not going away just because there's a $150 move in the gold price during this particular day, up or down. These problems are so endemic to the global macro system and the global financial system. Again, long answer to a short question, Elijah, but no, these price moves don't faze me because I hold gold for decades, not for weeks or months. I don't trade them. I save in them. The 1,000+ clients that we have from 90 different countries are doing the same thing. And any gold investor right now understands this perfectly. It doesn't faze me in the slightest, Elijah. It's a short answer. As of this recording, central banks hold more gold than they hold U.S. Treasuries. And even Judy Shelton wants to issue a gold-backed U.S. Treasury at the long end. Why? These are just open and obvious signs that the world is turning away from a debased dollar, a debased greenback. Still very powerful. We can talk about that. But they're saving in precious metals because it holds its value better than paper money. We can't say it enough. There's 5,000 different ways to say it. We can't say it enough. This is not a gold bug case. This is a macroeconomic shift. This is a major shift. It's not the end of the world reserve currency, certainly not yet. It's not even the end of the dollar, but it is a massive shift from the petrodollar to the U.S. Treasury markets, to the gold stacking of central banks, to the BIS making it a tier 1 asset. What more evidence do you need that there is a shift here? So again, goes back to whatever the gold price does today or tomorrow is really irrelevant in the larger scheme of the direction it's going.
Matthew Piepenberg highlights that the sharp fluctuations in gold prices, such as drops of $180 or rebounds of $105 within days, are a normal feature of a bull market rather than a sign of instability. He suggests that these shifts simply eliminate short-term or highly leveraged traders. To him, gold's enduring physical and chemical stability grants it a timeless quality, allowing it to outlast any monetary or geopolitical turbulence. Rather than viewing gold as a speculative asset, Piepenberg sees it as a long-term vehicle for preserving wealth and shielding investors from structural weaknesses in the global financial system. He further emphasizes that the increasing accumulation of gold by central banks and renewed talks of gold-backed U.S. treasuries mark a decisive move away from reliance on fiat currencies. Gold, in his view, serves as a geopolitical hedge effective, particularly when global tensions directly influence the US economy. These developments, he argues, signal an unfolding monetary transformation in which gold reclaims its place as a dependable foundation of value amid the fragility of modern financial markets.
If you look at treasury auctions, if you look at the net dumping of U.S. treasuries and the stacking of gold, if you look at what the BIS is doing, what the IMF is doing, if you look at what central banks are doing, if you look at the fact that, central banks now, as of this, again, recording, own more gold and hold more gold than U.S. treasuries, that if Zeberg, for example, and many like him say, if the market crashes, that the world's going to go to U.S. treasuries, and the US dollar as a safe haven. I would argue that that is not going to be the case because it's already not the case. The world's already turning its back on the US 10-year, the US 30-year, the US Treasury, and stacking gold. So if there is a mean reversion moment, as Zeberg predicts, and he could be right, in 2026, 2027, or tomorrow afternoon, that the world's not going to react the way it did in 2008 because they're going to go to gold more than US Treasuries. And so you won't see a spike in the DXY and you won't see a 30% retracement in physical gold. Now, again, that's just my view. He's arguing that history repeats itself or history rhymes, and that the next market crisis will be very similar to the case study that was the great financial crisis. Again, I'm saying that's not necessarily the case. The world's already moving away from the safe haven of the 10-year and the dollar to physical gold. But, even if there were a spike in the DXY, even if there were a safe haven run, as Zeberg says, in the next market moment, I actually agree more with Brent Johnson, who also sees a stronger DXY if there's a crash in the markets. But as Brent Johnson said, you can still have a strong dollar, a rising DXY, and a rising gold price. So net, I guess I'm arguing that if we have another moment, which is a whole other discussion about market risk, that we won't necessarily see gold retraced by 30% and silver by even more. That's my view. Again, it's my bias, my conviction, perhaps me selling my book, but I think the evidence suggests that we could count on a far more rising gold price rather than falling gold price in the next crisis. Now, of course, whenever there's a market crisis, there is a sell-off, as we saw in 2008 in precious metals, usually because investors have to sell on margin or they've lost money on margin. They need a good asset to cover their margin costs, and they will sell some gold. But even if we had a 2008 moment where gold retraced, it would still spike back up again as it did post-great financial crisis. So even Zeberg, who sees a potential large pullback in gold if the markets crash, ultimately sees gold racing to the moon. So all of us, Brent Johnson, Zeberg, myself, have different views on what the DXY could or could not do. Even Brent Johnson and myself still see rising gold even if the DXY spikes. Zeberg sees a big retracement. Guess what I'm trying to say is all three of us, though, still see gold far, far higher after the next moment, if we have an moment in this Fed-supported markets. And this is my long-winded way of closing by saying, if you're holding gold as a strategic reserve asset, as a store of value, and you buy it at 4,000, 3,000, or 4,500, if you're holding for the long term, if you're thinking about the legacy, if you're thinking about the purchasing power of your actual real money, if you're thinking about your kids and your grandkids in safety and whatever may come, if you're holding gold for the long run, even those who see a retracement in gold certainly do not consider this the last dance for gold and see it in the much, much higher valuations. So I wouldn't be worrying about a pullback to enter this market. Again, I'm agnostic whether you come to my office or not, but I don't want clients to not buy gold because they're waiting for a pullback. And I'll close with this. When Henrik and I were in South Africa in February of this year, he was saying the same thing, 30% chance pullback. At that time, gold was at 2,900. So a lot of listeners might have thought, well, if Henrik says 30%, I better not buy now. I better wait for the pullback. You fast forward today when gold's at 41, 4,200. Even if we had a 30% pullback today, gold would still be higher than it was in February. So if you were waiting for that pullback, you were chasing the wrong goalposts. I'm saying trying to time this market as a gold investor for the long term is a fool's errand. I don't know what the gold price is going to be tomorrow or the day after tomorrow, but I'm very confident where it's going to be 5, 6, 7 years from now, and that is much higher than the current price. And no matter what the price of gold is, it will be certainly a stronger piece of store of value, piece of wealth measurement than fiat money, whether it's the dollar, the peso, the yuan, the Swiss franc, the euro, the Canadian or Australian dollar. That is my strong, strong conviction. That is not selling a book. And there are Jeremy Granthams in the stock market. There's the Gunlaks in the bond market. There's even Morgan Stanley, the great big, too big to fail bank. We're all seeing the long-term direction of gold. I just want your listeners to think, if you're thinking longer term, don't be trying to pick your entrance windows or your exit windows for a trade. Nobody, even the best portfolio managers, can never pick a bottom or a top. This is certainly not a top. It's certainly not the end of a bull run in gold. And I just want to make that very clear. If you're thinking about preserving your wealth longer term, the daily gold price should not be your priority or your main concern. If you're a trader, there's nothing I have to say. I'm not saying I'm against traders. I have no advice for those that are just following technical exit and entry signals. Most people do it badly. But if you're If you're seeing gold as a store of value, as a wealth preservation asset, the things that Egon von Greyerz has been pounding his fist on for decades, it doesn't matter. Egon bought at 300. He's never looked at the price since, and it's now at 4,200, 4,100. He's not doing a victory lap. He's not declaiming victory. Neither are we, because we see gold much higher, and we don't measure our wealth in dollars or Swiss francs or euros. We measure our wealth in grams and ounces and kilos, and that's something each of your listeners have to decide for themselves. That's the historical risk we're talking about. That's the banking risk we're talking about. That's the currency risk. Get away from all the fog, all the data, all the yield curve, all the currency, all the DXY numbers, all this noise, and just understand that fiat money is a beautiful ice cube. It's melting. If you're measuring your wealth in that ice cube, you're taking huge risks.
The global financial landscape is witnessing a profound shift as nations, institutions, and central banks steadily move away from US treasuries toward physical gold. This transition signals diminishing faith in fiat-based assets and a recognition of gold's enduring role as a true store of value. Even if future crises emerge, history suggests any short-term retracement in gold would be temporary, followed by a powerful rebound. Why would investors cling to melting fiat currencies when tangible value lies in gold? Attempts to time the market or wait for pullbacks have proven futile. Gold's trajectory remains upward across years, not days. Amid mounting debt, currency debasement, and systemic fragility, preserving wealth now demands long-term conviction, valuing gold not in dollars but in ounces, grams, and lasting purchasing power. If you found this information valuable, make sure to hit like and drop a comment below with your thoughts. Don't forget to subscribe and turn on notifications so you never miss the latest updates. Thanks for watching.